The IRS unintentionally created a hidden exit route inside America's retirement system. That doorway unlocks during the calendar year you turn 55. Most individuals don't realize it exists until age 56. At 54, you are still standing inside the preparation stage. The gap between those two realities is the gap between a planned departure and a financial disaster disguised as retirement. Here is why this becomes especially harsh. More than half of employees, around 58%, stop working sooner than expected, typically because of situations they never saw coming. Among people who retired earlier than planned, health concerns ranked first at 46%, followed closely by work-related problems at 43%. Only 21% reported retiring early because they had achieved complete financial stability. Everyone else did not pick the timing. The timing picked them and caught them holding the wrong account setup, the wrong assumptions about withdrawals, and no bridge connecting where they stood to where they needed to go. Buried inside IRS regulations is an exception that can completely protect you from that outcome. It is known as the Rule of 55, and at age 54, you still barely have enough time to line yourself up correctly before the opportunity arrives. This video is your operating blueprint. Here's exactly what I'm about to explain. The technical reason why 55 operates like a hard cutoff, not a recommendation, not a flexible guideline, and why age 54 specifically represents your final meaningful year to prepare correctly. I'm also going to break down the 4 connected problems every legitimate early retirement strategy must solve simultaneously, because solving only one of them is how people end up with every piece on the table and still lose the match. I've spent more than 10 years operating a company surrounded by tax attorneys and accountants who explained how money truly flows through the American retirement structure. Not how it appears in marketing material, but how it behaves on actual tax filings. Several $100,000 of my own capital are invested using the exact framework I'm describing. This is not hypothetical. The core image I want you carrying through this entire discussion is the idea of a launch window. NASA uses that phrase for the exact period when the alignment of the solar system is correct for a mission. Launch within that window and you arrive at the destination using the fuel you planned for. Miss the window and either you wait for another opportunity, which sometimes takes years, or you burn dramatically more resources attempting to compensate. The window does not bend around your personal schedule. It does not care whether you feel prepared. It opens, remains available briefly, and eventually shuts. The Rule of 55 works exactly the same way. It is a launch window embedded directly into federal tax law, and I'm going to show you precisely when it opens, when it closes, and most importantly, what you must do at 54 to ensure you are positioned correctly when the opportunity appears. Think about the Rule of 55 as the launch window. Anytime the metaphor returns in this video, remember that missing a launch window is not merely inconvenient. It forces a complete redesign of the mission at a fuel cost you may not be able to survive. In a moment, I'm going to show you the exact IRS mechanics that make this tied to age and the single most common mistake financially intelligent people make in their early 50s that permanently destroys access. But before that, here is something about your own career timeline that should make you uneasy. 28% of dependable longtime employees experience at least one harmful layoff between turning 50 and retiring from work. Another 13% of workers who begin their 50s in stable long-term positions unexpectedly retire under circumstances strongly suggesting they were pushed out. They initially tell researchers they intend to continue working for years, but shortly afterward they suddenly announce retirement while their income and earnings fall sharply. Jeffrey Wanger, senior labor economist at the Rand Corporation, explained that many of these individuals were likely laid off, but describe it as retirement to avoid embarrassment. There is enormous social stigma attached to being separated from employment. He explained that even people who were terminated or dismissed often say they retired simply to preserve dignity. So the actual numbers look like this. Place 100 full-time employed 50-year-olds inside a room today. By the time they arrive at retirement age, more than half will experience an involuntary separation, forced retirement, or a decline in working conditions serious enough that leaving becomes the only practical outcome. According to the 2025 EBRI Retirement Confidence Survey, workers expect to retire at a median age of 65. Retirees actually stopped working at a median age of 62. That 3-year difference has remained stubbornly consistent for decades across many surveys. 3 years sounds survivable until you calculate the cost. 3 years of earnings disappear. 3 years of Social Security credits remain unearned. 3 years of portfolio withdrawals begin earlier than your projections expected, and 3 years of healthcare costs become your responsibility during the exact period before Medicare eligibility when private insurance costs are highest. These findings matter because many workers assume they can simply continue working several extra years to compensate for insufficient retirement savings. That assumption fails nearly half the time. Here's a story that illustrates this perfectly. There was a supply chain manager at a mid-sized manufacturing company in Ohio, we'll call him Dale, who spent 22 years with the same employer. Reliable employee, $300,000 inside his 401k. His strategy was simple. Continue working until 62, claim Social Security at 65, and retire smoothly with Medicare fully active. In 2023, his division went through restructuring. He survived the first wave. In 2024, at age 54, he received a separation package. He accepted because the direction was obvious. Dale was 54 years old with $300,000 saved, and he could not access it without triggering a 10% federal penalty on top of ordinary income taxes. Not because he made a mistake, but because he missed the launch window by 1 calendar year. The rule requires that you separate from your employer during the year you turn 55 or later. If you leave during the year you turn 54, you cannot begin taking penalty-free withdrawals once you later become 55. The window was still 1 year away, and his employment ended before he reached it. This is the core issue the mainstream retirement conversation completely ignores. The choice to retire early may not belong to you. The preparation necessary to survive it absolutely does. Stay with me because this next section changes how you should think about your account structure immediately. The Rule of 55 is an IRS exception, allowing workers who leave employment for any reason to begin taking penalty-free distributions from their current employer's retirement plan during or after the year they turn 55. Normally, withdrawing money from a qualified retirement account like a 401k before age 59 and a half triggers a 10% early withdrawal tax penalty. The Rule of 55 removes that penalty, though not the income tax. You still owe taxes on the withdrawal itself. What disappears is the additional 10% punishment for touching your own savings before the standard retirement threshold. This rule allows access to retirement funds as much as 5.5 years earlier. If your birthday falls late in the year and you separate from work earlier that same year, you could gain access long before age 59 and a half, which is the standard point where early withdrawal penalties disappear. 5.5 years is not trivial for somebody planning an early exit. That is the difference between a manageable bridge and a decade-long cash flow nightmare. Now, here is where the trap appears, and this is why age 54 matters so much. The Rule of 55 does not apply if you left your job at age 53, for example. You cannot wait until 55 and then suddenly begin taking penalty-free withdrawals from your 401k. The exception is not retroactive. You cannot apply it later for a separation that happened too early. The calendar year you leave employment is everything. Beyond the timing trap, there is another structural trap catching people who actually followed perfectly reasonable financial guidance. The rule does not apply to IRAs. If you separate from employment and hope to use the 401k withdrawal exception at age 55, your money must remain inside the employer-sponsored plan until at least age 59 and a half. Once those funds are rolled into an IRA, the exception disappears permanently. Pause for a moment and really absorb that. Nearly every financial media article, every account consolidation recommendation, every Simplify Your Retirement Accounts guide has encouraged people for years to roll former 401ks into IRAs. Fewer accounts, potentially broader investment choices, more flexibility. That advice is not technically incorrect on its own, But the instant you complete that rollover, you permanently close the Rule of 55 door on every dollar transferred. IRAs do not qualify for this exception. End of story. So, the individual who followed all mainstream guidance, consolidated accounts, simplified everything, behaved like a responsible investor, accidentally built a wall between themselves and one of the most valuable withdrawal exceptions in the entire tax system. You assume the problem is accumulating enough money. The real problem may be that your account architecture quietly guaranteed you cannot reach your own savings exactly when you need access most. There is one more level to the trap. To actually use the Rule of 55, your employer retirement plan must permit these early withdrawals. Some companies choose not to allow them. That is legal and fairly common, which means the first phone call you make, not tomorrow, not after this video ends, is to your plan administrator. You specifically ask whether your plan allows penalty-free distributions under the Rule of 55 for employees who separate during or after the year they turn 55. You obtain that answer in writing because your entire exit strategy may depend on that single detail. Now let's discuss taxes. Any withdrawal taken under the Rule of 55 still faces a mandatory 20% income tax withholding rate. That is not a penalty. It is simply an advance payment toward your eventual tax bill. If your actual effective tax rate ends lower than 20%, you receive the difference back as a refund later. But timing still matters enormously. If you separate mid-year after already earning substantial W-2 wages, your total annual income may push you into a higher tax bracket. The smarter strategy is delaying your first Rule of 55 withdrawal until January 1st of the following year, when your employment income falls to zero and your effective withdrawal tax rate may drop significantly. As one certified financial planner explained, if you worked most of the year and earned high income, it often makes sense to delay withdrawals under the Rule of 55 until the following calendar year, because the added income could push you into a higher marginal tax bracket. At 54, you still have enough time to build this correctly. You still have time to inspect the plan, verify eligibility, stop rolling old balances into IRAs, and start accumulating assets inside the plan connected to the launch window. So imagine your financial advisor sitting across from you saying, "Honestly, I recommend rolling that old 401k into an IRA. You'll gain access to far more investment choices." And technically, he is correct. What he doesn't realize is he just handed you scissors and encouraged you to cut the cable attached to your emergency escape hatch. Amused disappointment. That is probably the only proper reaction. Here is the section retirement calculators never include. Understanding the numbers is one thing. Constructing a working system around them before time runs out is completely different. I had access to much of this information for years. Nothing changed until I organized everything into a framework that showed the sequence, what to do in what order, and which numbers belonged to every stage. That is why I created a digital guide called The Exit Code. It contains 8 chapters of concentrated research, no fluff, no motivational filler, distilled from 5 decades of retirement data into a mathematical system for determining exactly when you can escape the rat race. 2 sections inside that guide connect directly to this conversation. The first is the 58% rule, the buffer strategy designed for people who understand the decision to retire early, may not fully belong to them, and who want a plan capable of surviving an involuntary exit without collapsing their financial structure. The second is the dynamic withdrawal framework replacing the 4% rule I'm about to discuss, adjusting withdrawal rates according to actual market conditions instead of assuming one static percentage magically works regardless of market behavior during retirement. There is also a chapter covering what I call the invisible $14,000 bill, the healthcare insurance gap between early retirement and Medicare that became dramatically more expensive in 2026 for reasons I'll explain shortly. You can access the exit code for less than the cost of a dinner through the description link below. Every year you delay building this framework, compounding mathematics start working against you instead of for you. Now, let's discuss the healthcare ambush because it is far worse than most people understand. At this point, you're probably thinking, all right, I understand the 401k structure. I confirmed the plan eligibility. I understand the calendar year rule. I stopped moving money into IRAs. But how do I survive financially between ages 55 and 65 without employer insurance and without Social Security? This is the wall that silently destroys more early retirement plans than almost anything else. You do not qualify for Medicare until age 65, even if you retire earlier unless you qualify through disability. That is a hard, immovable line. No amount of wealth changes the enrollment age. And here is the exact reason 2026 became significantly more expensive for early retirees. Many Americans previously qualified for ACA subsidies helping cover insurance premiums based on household income. But those subsidies expired at the end of 2025, and congressional efforts to restore them remain uncertain. Those enhanced subsidies existed since 2021. For 4 years, they dramatically reduced healthcare costs for people retiring before 65. They are now gone. The cost of the healthcare gap just reset to full unsubsidized pricing. ACA marketplace premiums for a 62-year-old generally range between $1,000 and $1,800 monthly into 2026. Spending approximately $12,000 to $13,000 annually per person on premiums alone can consume a massive portion of retirement income, especially for households depending on savings withdrawals or investment income. For a married couple retiring together, that number easily exceeds $24,000 every year. In premiums before deductibles, before medical events, before out-of-pocket maximums ever matter. Now imagine a full 10-year retirement bridge before Medicare. A couple retiring at 55 could face roughly $240,000 in healthcare premiums alone, simply to remain insured until age 65 using 2026 pricing. According to Fidelity Investments' 2025 retiree healthcare cost estimate, the average 65-year-old retiring in 2025 will spend approximately $172,500 on healthcare and medical expenses throughout retirement, excluding long-term care. And remember, that number starts at Medicare age. The pre-Medicare years exist on top of it. This is the invisible bill. It rarely appears inside standard Monte Carlo simulations. Advisors project portfolio growth, assign withdrawal rates, and hand you a 20-year chart. Healthcare costs become a footnote if they appear at all. In reality, for the average early retiree, healthcare becomes one of the largest expenses during the entire first retirement decade. Here is the surprising flip side, and again, this is why age 54 matters so much. A CA subsidy eligibility depends on modified adjusted gross income. If you can control your MAGI, particularly by drawing from Roth accounts instead of traditional pre-tax retirement accounts during early retirement, you may qualify for subsidies dramatically lowering healthcare premiums. Roth IRA withdrawals do not count toward MAGI. Traditional 401k or IRA withdrawals absolutely do. If you own both account types, withdrawing from Roth accounts first can help keep your MAGI under the thresholds, reducing or eliminating subsidies. The difference between $55,000 and $65,000 of MAGI may equal several $100s monthly in insurance premiums. That level of savings justifies serious planning. The tool used to execute this is a Roth conversion ladder. You begin around age 54 while you still have several high-income working years remaining, converting targeted amounts annually from pre-tax retirement accounts into Roth accounts. You pay taxes now at your current marginal rate. During retirement, those converted funds become tax-free and invisible to ACA subsidy calculations. The latter usually requires around 5 years of conversions before becoming powerful. At 54, you still possess enough runway. At 59, you are scrambling to fix consequences. Only 48% of pre-retirees intentionally account for higher healthcare costs inside retirement planning. The remaining 52% discover the invisible bill the painful way. This is where I want to introduce a second storyline because the biggest strategic failure I repeatedly observe is people treating these decisions sequentially when they must be handled simultaneously. Not first fixing account structure, then worrying about healthcare, then thinking about Social Security. Everything has to sit on the board at the same time. Meet Marcus. Marcus is 54, a senior project manager at a technology company that survived 2 rounds of layoffs in 2023 and 2024. His department made it through both rounds, but Marcus is experienced enough to understand that surviving 2 cuts inside a shrinking company does not guarantee long-term safety. Financially, he has done reasonably well. $480,000 divided between his current employer's 401k and 2 older IRAs from jobs he left years ago. His plan is staying employed until 62, claiming Social Security early, and using portfolio withdrawals for everything else. Here is Marcus's problem. In 2021, he rolled his strongest employer plan, the account holding roughly $400,000, into an IRA. A YouTube video encouraged him to consolidate for simplicity, cleaner records, and broader fund selection. Everything in the video was technically accurate, but Marcus now has almost no money eligible for the Rule of 55. His current employer plan contains only around $80,000. The remaining $400,000 sits inside IRAs that specifically do not qualify for the Rule of 55 exception. If Marcus loses his position at 56, which is completely realistic inside his industry, his maximum penalty-free access equals about $80,000. The remaining $400,000 stays locked until 59.5 unless he pays the 10% penalty or enters IRS Rule 72T, which forces fixed equal distributions for at least 5 years. Marcus made one completely reasonable sounding decision at age 51 that dramatically complicated his retirement structure at 54. The choice was not catastrophic. He is not destroyed financially, but his flexibility became significantly narrower than it would have been if he had simply left the old 401k untouched. I will return to Marcus later because there is still a recovery path and it begins immediately. But there is another layer because even if you execute every mechanical step correctly, correct account structure, proper healthcare bridge, verified Rule of 55 eligibility, there remains one variable completely outside your control that can destroy an otherwise solid retirement plan within 3 terrible market years. And it hits early retirees harder than anyone else. The concept is sequence of returns risk, the danger that the order in which investment gains and losses occur, not simply the average return itself, determines whether your portfolio survives a decades-long retirement. The identical annual returns arranged differently can create either a comfortable 30-year retirement or financial collapse by year 18. The reason this risk stays invisible during working years yet becomes devastating during retirement comes down to one reality. While accumulating wealth, return order barely matters. During withdrawal years, return order becomes everything. Research from WDEFA estimates approximately 77% of a portfolio's eventual retirement outcome can be explained by returns during only the first 10 retirement years, not 30 years, the first 10. If a bear market arrives during year 2 instead of year 22, the damage cannot recover using the same mechanisms protecting younger, accumulating investors. Sequence of returns risk refers to the danger that weak market performance during the opening years of retirement permanently damages a portfolio. Once withdrawals begin, losses hurt more because you are selling assets at lower prices while simultaneously reducing the remaining capital available for future recovery. Look at historical evidence. A retiree beginning retirement in the year 2000 experienced perhaps the harshest sequence in modern history. The dot-com collapse followed quickly by the 2008 financial crisis. 2 brutal bear markets within 9 retirement years created a lost decade where a 4% inflation-adjusted withdrawal strategy left the retiree with roughly 60% less wealth by 2010 compared with the same strategy beginning in 1990. And this connects directly to another problem with the framework most retirees use for withdrawals. The so-called safe withdrawal rate declined to 3.7% in 2025 from 4% in 2024 because of changing long-term financial assumptions according to Morningstar research. The 4% rule itself, originally created by Bill Bengen in 1994, using data back to 1926, was always a model based on assumptions. 4 major factors weaken the safety of the 4% rule for early retirees. The Trinity study tested 30-year periods. Someone retiring at 35 or 40 requires their portfolio lasting 50 to 60 years. Every extra decade meaningfully reduces success rates. A retiree at 55 still faces a 40-year horizon. The math changes substantially. The 4% rule, by the way, was not delivered on sacred stone tablets. Bill Bengen published it in 1994 using historical information beginning in 1926. Bengen himself later revised the number upward, most recently suggesting 4.7% as the worst historical safe withdrawal rate. He told CNBC in 2025 that retirees rigidly following 4% are probably depriving themselves of retirement lifestyle they actually earned. Meanwhile, Morningstar responded in 2024, arguing the number should instead be 3.7%. The original researcher and one of the largest research firms disagree by a full percentage point on a figure quietly supporting millions of retirement plans. Your financial advisor probably still presents the 4% rule as though it were physics. It is not physics. It is a model built on assumptions. And several of those assumptions no longer fit early retirees with extended timelines. The answer to sequence risk is not panic. It is structure. Maintaining a cash buffer equal to 1 or 2 years of living expenses outside the equity portfolio prevents you from becoming a forced seller during the opening years of a downturn. You spend from the cash reserve. The portfolio remains untouched. Once markets recover, you refill the reserve. This is the bucket strategy, and it is not exotic. What it demands is capital and discipline. Both become significantly easier to build at 54 than at 57 when you are reacting to an unexpected separation. Now let's discuss the catch-up sprint, which almost nobody maximizes properly. The catch-up contribution limit for workers aged 50 and older participating in most 401k plans rises to $8,000 in 2026. That means workers age 50 plus can generally contribute up to $32,500 annually. That is meaningful by itself. But almost nobody discusses what Secure 2.0 changed. Beginning in 2025, individuals between ages 60 and 63 qualify for expanded catch-up contributions inside retirement plans. This applies to 401ks, 403bs, and governmental 457b plans. Already offering catch-up contributions, in 2026, this enhanced catch-up remains $11,250 rather than the standard $8,000. Between ages 60 and 63, you can contribute $24,500 in regular deferrals plus $11,250 in super catch-up contributions. A total of $35,750 into your 401k during 1 year. Then at 64, the enhanced catch-up disappears. You return to the normal catch-up limit. Once participants turn 64, they fall back to the standard 50-plus contribution rules. This creates an extremely specific 4-year sprint window, ages 60 through 63, unlike anything else in the tax code. If you are unemployed during those years, those contribution opportunities disappear forever. You cannot recover them later. The window shuts and never reopens. If you are 54 today, you still possess a direct 6-year path toward that sprint window. The question becomes whether you will still be employed and contributing once the window opens.